Hey everyone, and welcome. In today's explainer, we're going to cut straight through the noise right from the jump. If you spent, really any time online looking into trading, you have undoubtedly seen the flashy lifestyle content, right? The sports cars, the luxury watches, the promises of overnight wealth. Well, we're skipping all that BS today to build a rock-solid foundation instead. We're talking about Forex basics, the true market structure, exactly how it works, and honestly, why most beginners who skip this stuff end up seriously struggling later on.
Over $6 trillion. That is the daily trading volume of the Forex market. Let that sink in for a second. To put that massive scale into perspective, if you took the regular global stock markets, they'd look like a tiny drop in the ocean compared to this. The scale of Forex is just awe-inspiring. It's absolutely massive, and it is entirely decentralized. It's the largest financial market in the world by a landslide, and today you're going to learn exactly what makes it tick.
So think of today as your core syllabus. We're going to cover Welcome to the Market, Decoding Currency Pairs, Pips and Lots Explained, Leverage and Spreads, and finally, how brokers actually work.
Okay, let's dive right into part one. Welcome to the market, the macro view of global exchange.
So, what exactly is Forex? Well, foreign exchange is basically the global, decentralized marketplace where buyers and sellers exchange one currency for another at an agreed price. Unlike the stock market where you're buying a share of a company on a centralized exchange, like say the New York Stock Exchange, Forex is this massive interconnected global network of banks and institutions. And because there's no central exchange, trading happens 24 hours a day, 5 days a week across totally different global time zones. When you trade Forex, you aren't buying a piece of a company. You're simply buying one country's money while simultaneously selling another's.
Moving right along to Section 2, Decoding Currency Pairs, the Tug of War.
You can think of every trade as a kind of tug of war between two sides, a base currency and a quote currency. The base currency, which is always the first one listed in the pair, is always exactly 1 unit. The quote currency, the second one, tells you exactly how much of that second currency is needed to buy 1 single unit of the base. So, for example, if the euro-US dollar pair is sitting at 1.10, it means it costs exactly 1.10 US dollars to buy a single euro. It's this constant balancing act between two distinct economies. And these pairs, they basically fall into 3 main categories. First up, we have the majors. These have massive daily trading volume, and they always pair with the US dollar, like the euro to the US dollar. Next are the minors, sometimes called cross pairs. These feature major currencies, but they don't include the US dollar at all, like the euro paired with the British pound. And finally, the exotics. These pair a major currency with a developing economy, like the US dollar and the South African rand. Now, a quick pro tip for rookies here. Exotics can be wildly volatile and pretty expensive to trade. Sticking to the highly liquid majors is for sure the safest, most stable way to learn the ropes.
All right, Section 3, Pips and Lots Explained, the micromechanics.
Let's see how this all builds. If you're going to measure distance in the real world, you use a ruler, right? Well, in Forex, that ruler is the pip. Pip actually stands for percentage in point. It's the smallest standard unit of price movement. And for most currency pairs, it sits way out at the 4th decimal place in a quote. So if that euro-US dollar pair moves from 1.1000 to 1.1001, that tiny little shift, that is exactly 1 pip. When traders talk about the market moving, or they're calculating their gains and losses, they measure that movement purely in pips.
But here's the catch. Because currency movements measured in pips are incredibly tiny on a micro level, you can't just buy 1 single euro and expect to see any meaningful return. I mean, this is a $6 trillion market driven by massive institutions. So you have to trade in standardized quantities, or batches. In the Forex world, we call these uniform batches lots.
Now these two concepts, lots and pips, they actually multiply together to dictate your real financial risk and reward. Check this out. A standard lot represents 100,000 units of currency, which makes a single pip movement worth roughly $10. A mini lot is 10,000 units, making a pip worth about $1. And a micro lot is just 1,000 units, bringing the pip value down to roughly 10 cents. Understanding exactly how these units interact is absolutely non-negotiable for determining your position sizing before you ever even think about entering a trade.
Which brings us to Section 4, Leverage and Spreads, the costs and risks of the business.
Now, what's really interesting here is that before you can ever make a profit in the market, you actually have to pay a toll. And that toll is called the spread. It's simply the difference between the bid or the sell price and the ask or the buy price. Because of this little gap, every single time you enter a trade, you're going to start slightly in the red. There's really no getting around it. The spread is simply the immediate, built-in cost of doing business and gaining access to the market.
Next up is leverage, and this is a big one. Leverage is essentially borrowing capital from your broker so you can control a much larger position with a relatively small deposit. Think of it kind of like putting a 5% down payment on a house to get a mortgage, right? The bank lets you control a massive asset for just a fraction of the cost up front. So if your broker offers 100-to-1 leverage, you literally only need $1,000 in your account to control a massive $100,000 standard lot.
But this brings us to a really critical question that every beginner eventually has to face. Is leverage a trap? Look, it is incredibly easy to fall into the illusion that leverage is this get-rich-quick tool designed to just accelerate your success. But make no mistake, while leverage absolutely magnifies your potential profits, it equally and aggressively magnifies your losses. Using high leverage without a deep understanding of risk management can and honestly will blow a trading account in the absolute blink of an eye.
The whole point is captured perfectly in this hard truth straight from our source material. The key isn't to avoid losses, it's to survive them. You can't have a great strategy with poor position sizing and expect to last. If you want to survive this game long-term, understanding your lot sizes, calculating your leverage, and keeping your risk percentages incredibly tight isn't just a suggestion, it's absolutely mandatory.
All right, our final section, Part 5, How Brokers Actually Work, the Gatekeepers of the Market.
Let's pull back the curtain on the entities that actually take your clicks and turn them into real orders. To simplify this, let's track a single dollar through its life cycle. Step 1. You, the retail trader. You analyze the chart and you hit buy. Step 2. In mere milliseconds, that order goes to your broker, who provides the digital trading platform and extends the leverage to you. Step 3. The broker instantly routes that order to liquidity providers. That's the massive global network of banks and financial institutions that actually hold the currency and complete the transaction on the other side.
So the crucial point here is that brokers are incredible tools. They give you the software, the leverage, and the literal gateway to the global market. But listen to me carefully. Protecting your capital is entirely on you. Brokers simply facilitate the transaction. Your survival in the market depends purely on your discipline and your respect for the raw mechanics we just unpacked today.
So I'm going to leave you with this final, somewhat provocative thought. Are you going to master these basics, or will you rush the process and just become another statistic? The traders who actually last in this game are the ones who deeply understand the mechanics of pairs, pips, lots, spreads, and leverage. You have to respect the foundation before you ever go hunting for some flashy trading strategy. Thank you so much for joining me on today's Explainer. Study these basics, stay disciplined out there, and I will see you next time.